Okay, so how can a company that's all about brilliant ideas and code end up on the same path to success as a company built on, tons of concrete and steel? It seems impossible, right? Well, today we're going to solve that very puzzle by looking at what the financials really tell us.
All right, so let's kick things off with a bit of a puzzle. We're going to look at a tale of two totally different business models that somehow both managed to dominate their industries.
So on one side, you've got these American tech giants. They seem almost weightless, right? Their value is all tied up in ideas, in code, in the talent of their people, stuff that doesn't really show up on a traditional balance sheet. And then on the other side, you've got these Korean industrial powerhouses. I mean, they're built on these massive physical foundations. Their value is something you can literally go out and touch. So you see the problem, right? It feels like a total contradiction. How can two completely opposite paths both lead to the top? Well, the answer isn't just lying there on the surface. We've got to dig a little deeper. And to do that, we need a special kind of tool.
And just like any good detective, we need a magnifying glass. For us, that tool is a powerful little metric called return on equity, or ROE for short.
So what is ROE? Well, at its core, it tells you how much profit a company can squeeze out for every single dollar of shareholder money it uses. But it's way more than just a formula. Think of it like a powerful lens, one that lets us see right into a company's core strategy, its operational DNA. But here's the thing, just looking at the final ROE number, that's not the whole story, not even close. The real magic, the real clues, they show up when we take our magnifying glass apart and look at its three core components. This is where the company's real strategy starts to reveal itself. So what are these components? Well, it turns out that any company's performance, its ROE, boils down to a combination of just three powerful levers. If you can master these, you hold the keys to creating value. And you can think of it like this. There are really only three fundamental ways for any business to drive value. First, you can make more profit on each thing you sell. Second, you can sell more stuff using the assets you already have. Or third, you can use borrowed money, debt, to amplify your results. That's it. That's the game. Okay, so let's break them down. Lever number one is profitability. This one comes right off the income statement. It's that classic bottom line, right? How much profit is actually left over after you've paid for everything else? The higher your margins, the higher your profitability. Simple enough. Next up, lever number two, efficiency. This one is all about how productively a company uses everything it owns, its assets, like factories, machinery, inventory, to actually generate sales. And the story for this lever? It's told on the balance sheet. And for those big industrial companies we were talking about, a huge, huge chunk of their asset base is something called CapEx, capital expenditures. We're talking billions upon billions spent on physical stuff, like plants and equipment. This really is the concrete foundation of that asset-heavy model. But efficiency isn't just about big factories. It's also about managing your cash flow. Because look, if your money gets tied up in stuff you haven't sold yet, or in bills your customers haven't paid, it's just like the quote says. It's like a corporate blood clot. It stops the cash from flowing, and that can be incredibly dangerous, even if your profits on paper look totally healthy. And that brings us to our third and final lever, financial leverage. This one tells us how much a company relies on borrowed money to fund its assets. And you got to be careful here, because debt is a classic double-edged sword. It can absolutely supercharge your returns when times are good, but it will just as easily magnify your losses when things go south. All right, so now we have our toolkit, right? Profitability, efficiency, and leverage. It's time to go back to our original mystery. Let's see what story the data tells us about our two very different giants. And wow, this is where it all clicks into place. When we apply these three levers, the completely different strategies just pop right out. The US tech model, it drives its amazing returns with crazy high profitability and efficiency. But the Korean model, it makes up for lower margins, but using a lot of financial leverage. It's fascinating. They get to the same destination by taking completely opposite roads. And if you look at their balance sheets, they tell the exact same story. That US tech model is what we call asset light. Most of its value is in those invisible assets we talked about, the people, the R&D, the ideas. But then you look at the Korean model and, wow, it's the polar opposite. It is deliberately asset heavy. More than half of its value is literally locked up in physical factories and equipment.
And this is the key insight. The asset-heavy model isn't some kind of accident. It's not inefficient. It is a strategic choice. For these kinds of businesses, you have to pour the concrete to get the cash out. That massive investment is the business model. It's how they generate cash and how they absolutely dominate their market.
And what does all that investment get you? Well, it creates this enormous barrier to entry, a strategic moat, if you will. I mean, for a competitor to even think about catching up, they'd need hundreds of billions of dollars in capital. It's not just a small step up. It's like asking a student who just learned basic arithmetic to suddenly solve advanced calculus. It's practically impossible to make that jump overnight. So what this all reveals is that it's not about one model being better than the other. That's the wrong way to look at it. Instead, what we have are two completely distinct, incredibly powerful, and totally valid strategies for winning. One path is all about brain power and being flexible. The other is about brute force manufacturing and massive scale. And that's the real takeaway here. Once you understand this three-lever framework, a financial statement stops being this boring, complicated document. It transforms into a compelling story. A story about strategy, about risk, and ultimately about success. It lets you see the why behind all the numbers. So now you have the analyst's magnifying glass. You've got the framework. The next time you look at a company, you won't just see the surface-level headlines. You'll be able to break it all down, apply the levers, and uncover the real story of what truly makes that company tick.